The most common advice you hear is to diversify your investment portfolio, but diversifying your tax wrappers effectively has the potential to have an even greater impact on your wealth. There's a theory amongst financial experts known as the 4-box principle that offers the secret into minimizing the tax you pay on your retirement income. It's called the 4-box principle as it focuses on 4 core tax wrappers. In order, those tax wrappers are your pension, an ISA, a general investment account, and a bond. Ultimately, all of these tax wrappers have different uses and benefits, and these are applied differently depending on whether you are accumulating your wealth or drawing on your assets. Pensions are gross of all tax on the way in, which is why they are incredible for building wealth, and they are free of capital gains tax too. Importantly though, withdrawals from a pension are taxed at your marginal rate. Contributions to ISAs will have been net of tax on the way in, but once it's in the ISA wrapper, there will be no tax to pay ever again, which is an amazing thing. General investment accounts are a fully taxable environment, but you can helpfully make use of your capital gains tax allowance to access money tax-free. And finally, a bond essentially defers tax. You are able to access 5% of your initial investment every year with no immediate tax charge, and they are free of capital gains tax, but the gains that are withdrawn will be taxed as income. Whilst having all 4 of those may seem like an unnecessary amount of complexity, if you make effective use of them in the right combination, it can have a liberating effect on your wealth. If I take you through the numbers, you might start to realize what I mean. Let's take a couple with £2 million invested. They want to take around £90,000 a year in retirement. Using the 4-box principle, believe it or not, they can access every penny of this completely free of tax. Now, they've been working with a financial advisor in the run-up to retirement and so have been diversifying their money across the different tax wrappers. They have $750,000 in their pensions, $500,000 in ISAs, another $500,000 in general investment accounts, and $250,000 in an offshore bond. They take £12,570 each from their pensions to use their tax-free personal allowances, so that's £25,140 total. Next, they take £27,766 from their ISAs, which is completely tax-free, followed by £24,600 from their general investment accounts, again, completely tax-free, as they make use of their annual capital gains tax allowances. And finally, they take £12,500 from their bond, which is the equivalent to 5% of their capital. So again, there's no tax to pay. So in total, that's £90,000 a year, completely tax-free, which is absolutely astonishing. So if you're building your wealth towards retirement, make use of the 4-box principle to make sure that you can access your money in as tax-efficient a manner as possible. And if all of that feels a little bit too complicated, maybe take some advice. Because remember, your money really does matter.